Welcome back. So in today's topic, on today's video, really what we're gonna do is we're gonna discuss and add some more context to what we already spoke about in the previous video on the three factors or three consistent market behaviors on how the market moves. Now, number one, we talked about price moving from premium to discount and discount to premium. All right. So this is consistent, and this is also a topic that we learned about in the very first video in the fundamentals playlist, that is the range theory topic. And so I said something there. You remember I said that price is always within a range. So basically um what happens is that at any point in time, price is always within a range, and the range is the high and the low, right? Particularly swing high and the swing low. So price is always within a range at any moment in time. Now, range theory, or this first factor here, it applies whether price is trending or price is consolidating. Okay, now price can either go up or go down or consolidate. Usually that's what price does. Those are the only three things you find in the price. And so when price is trending, we have ranges in price, the small ranges within bigger ranges. But when price is consolidating, we have price moving within the boundaries of the range. That's why it's also called range bound market, right? Consolidation slash accumulation slash range. Right. So for a range, an example from last year's price action where we had a consolidation throughout the year. On 2 week time frame, we see the price is just trading within the range, within the boundaries of the range that was created, the daily range rather, particularly on this one. So what price is doing is just it was selling from premium to discount, discount to premium, premium to discount, and all that. All for a very long time, for a couple of months, really, right? Last year, majority of the trading year last year, 2023, price was actually consolidating. That means it was moving within the boundaries of the range. So I'm showing you, firstly, we're dealing with those three factors, three important principles in how the market moves. And I'm showing you how it applies across the three, I guess, market movements, if you will, right? Either on an uptrend or downtrend or consolidating. And I'm showing you also which ones really apply. So range theory, premium and discount apply whether we are consolidating or we are trending. Now, in a trending market, previously when we were dealing also with still on this premium and discount topic, if you watched it previously, we talked about is that when price is say in an uptrend, what you're doing is measuring the expansions, because what happens is price will expand and retrace. So in an ideal market, you want to see price retracing down to discount, and then buying, tracing down to discount and buying, tracing down to discount and buying. Then for a downtrend, you want to see price expanding lower, retracing up to premium, then selling, retracing up to premium, and then selling, retracing up to premium, and so on and so forth. Okay, so range theory, which is premium and discount, it applies across a consolidating market, and a trending market. Okay, let's look as an example here. Let's take out an example here in the H1 time frame here. So it was the only like piece of price action I could get, which is pretty clear. I want you to see. Previously I've shared an example along this line on the video. I think on the video on discount and premium, the latest one. So what happens is, so we have a range from this low to this high. See, we expand higher, trace down to discount, see an expansion, right? And here as well, from this range from this low to this high, we expand higher, trace to discount, we expand higher, trace to discount, and expand high. That's in an uptrend. In a downtrend, see from this high to this low, that's my range. See an expansion down, a retracement to premium, and then an expansion down from what? From this high to this low. See an expansion down, the retracement up to not all the way into premium, but it's the 50% line to equilibrium. Then on this range, which is from this high to this low, we see what expansion down, retracement to premium, and an expansion down as well. Now, but because we're dealing with daily bias, right? We're dealing with daily bias, really more concerned with the general direction of price. Okay, for now, not short term or intermediate time frames really, but more interested in really the general direction of price, overall direction of price, not the intraday. Because intraday price goes up, goes down. Both ways they work. Why is it he said that every day the bias is both sides. Bias is both, right? Every day, that's what he said. Because it can be profitable buying or selling, regardless of whether the day ends up being a buy or a sell day. Okay. So that's all right. So what we have here is an actual trending market. Okay. And let me start all the way from the top. Okay. So again, say in the downtrend, you're gonna see price expanding down lower and doing what? Retracing up to premium. So and then that's we can have in a continuation. Basically, with premium and discount, what you use is the way that you use it is that above 50%, right? We said this before. You want to be a seller. You want to be looking for sell opportunities above 50%. You want to be a buyer below 50% in discount, right? In premium, you want to be a seller. So that said, when you have a range this and you have reason to look for sales, what you're doing is just gonna theorize, okay, I have an area just from here all the way up to where say the range high that I can look for selling opportunities. Where is price most likely to sell inside this area here? Well, that's what we call premium arrays, right? First, we have a very short block and also a very fairly gap, right? Just above what 50% above equilibrium, and then boom, we sell up from there, from those, from that P array, and we see it breaking market structure. So that's an expansion here. We take a fib high to the low. If time price break structure, it tends to have a retracement, and we just repeat the process. Now notice P is higher up to premium, right? But then price also doesn't break structure, so it traces back up again one more time into premium. So above 50%, what do you see in price? In this range or in this leg of price, we have bearish pidary in the bearish order block. Okay, and this is just at the opening of it right here. Okay, and if you take really look into that, you'll likely see that yeah, price came out and sold at the main threshold of that order block right there, main threshold of order block, and we had about a continuation sell, right? Broke structure here with those relatively cut lows, and along there. All right, after that you can see a retracement up, but here we have a high and a low, right? You can fib from the high to the low, where you see again same thing above 50%. You look for sales, right? You want to look for selling above 50%, and then what is above 50%? We have a bearish level gap, okay, and say those two a bearish uh order block, right there. Either using the openings of the bodies, or using the entire candle. So if you like at the low here, right? So you're gonna see, as you've seen with this one here, that when these two, let's say two P arrays are overlapping, it's kind of like a high probability area. So in this particular case, you had an overlap again of the R block and favorite gap here as well. We have a low here too. So after that, see another an expansion and to ultimately to break this structure here, right? So this time we have a swing high here, again a swing low there. So you repeat the process again. You see an expansion lower, a retracement up to premium. What is in premium? Above 50%, what do you see in this range from this high to this low? a bearish PDRA, a bearish order block, right? And okay, see price selling from there. So this is on the downtrend, right? What about on this uptrend? On this uptrend, starts somewhere around here. After that consolidation, see price goes down to discount, and what is in discount? We have favorite gap overlapping with an order block and a breaker block as well. And we already spoke about this, right? When there is an overlap like that, you see a reaction, a nice reaction on that. Of course, we broke structure, but then on here we did not retrace down to discount. Price continues from there, right? With no retracement, further retracement after that, and that's all right. See, now we've dealt with premium and discount. Let's move on to the next. And the second one is that price will move from buy side liquidity to sell side liquidity, and from sell side liquidity to buy side liquidity. Now, let's also look at some charts again to further discuss this one. Now, here's the kicker when it comes to the second principle. Price moves from buy side liquidity to sell side liquidity. Is that unlike the first one, premium and discount, I found through my own personal experience. Okay, I'm not saying that this is what it is. I'm not saying that this is the whole thing and I should go by my word, but from my experience, what I've realized is that now this one particularly applies to consolidating markets, right? Consolidating price. So what happens is I found that it's unreliable to use it or to try to, yes, to use it really in a trendy market. And I'll show you why when we're dealing with the third one. So price will move from buy side to sell side, right? So if I already shown you that last year was an actual consolidation, like a very consolidating year. And if you've been following me on my socials, and particularly you've seen my Instagram highlights, you know that I had very was a very successful year because in my own personal opinion, I believe that consolidations are the easiest to trade, right? And I'll show you why. So start maybe from here, right? You see a high, swing high there, swing high here, and swing high there. Then we create a low, we go high. Above here and above here and above there, we rest in buy side liquidity, right? Price going up takes out this high, right? That's the high buy side liquidity, right? And of course, if you wonder when you're looking at price currently, what you see is that means that this is where sell side liquidity is resting, right? The price does not go all the way to the low, okay? Goes a little bit higher one more time. Now in this particular case, when it's here, where's buy side liquidity resting? Well, it's still resting above here and above there, but also above this one here. This recently created high because it's a high that took out liquidity. It's seen as a like a strong or safe high, and it's used there. A lot of stops, you find that stops are placed above it. And so now to kick off things, you see price going up, taking out outside liquidity, right? And so repeat the process, right? So sell side liquidity is here, right? And but in this range, when price went all the way up there to take out buy side liquidity, where is sell side liquidity resting? Well, below this swing low, this intermediate swing low here, and this low as well. So I want to see price move from buys, or at least what did price do? Well, it moved from there, right? And then to say from buy side and then to sell side. So there's still sell side here, okay? So it doesn't reach all the way to this low, but we move from buy side then to sell side. Then price moves back again, and there's buy side liquidity here and buy side liquidity at this thing high here as well. Let's take this higher one. And so after taking out those two highs, that's buy side liquidity. Next day, you're gonna move from to sell side liquidity. And where is sell side liquidity resting next? At the slow, at the slow, and at the slow, right? Notice this is the beginning of the consolidation anyway. I'll show you. So this is just before it is obvious that the year is consolidating. So before that, price was trending, and then from here, after this retracement down here, now price starts to move in a consolidation. So buy side to sell side, buy side to sell side. Now sell side to buy side. Where is buy side? Above this high here. This is like the external range here, right? And the old highs, this one and that one as well. And boom, all right? So move from sell side to buy side. Next, sell side, possibly, right? So on this range, right? It's also advised to not don't try to the target the external. Don't try to think too much. Maybe think that if you have a range, like say the range, like this one, don't look too much into the external liquidity, right? Ignoring what is internally. Like if price takes out buy side liquidity here, you probably think that price taking out buy side liquidity. Don't have that idea that next thing price is gonna be seeking for is sell side liquidity, but thinking below this one here. I mean, come on, it's unrealistic, really, uh, and it's too far, right, of a price target when you have all those swing lows within price, right? And I guess price sticks out this low, and this low, I believe, yes, no, maybe not. Nice, relatively quite lows, and so we see a retracement up. See how in this range, after price took out this low here, in this range, we don't have a swing high to references buy side liquidity. So price does not head or retrace up the buy side liquidity maybe for this 5-day gap here, right? We'll deal with that again in the next one. Right now, we're still focusing pretty much on liquidity, full liquidity, right? And so buy side, right? This whole side, and then create a high, create a low here, create a high here, and then this low. Well, it kind of takes out this two lows here, kind of, but not really that much. So south side, then up to buy side liquidity there, and from buy side to south side, that's relatively close. Now this is an adequate stop hand of those relatively close right there. So then south side to buy side, then buy side to south side, then from south side, boom, buy side liquidity there, buy side liquidity there, right? Take the highest one, and after taking buy side liquidity, move down to south side liquidity, right? And then price again, same thing. You look in this range here, you notice it doesn't have swing highs except the very high there. So this is a retracement up, and then boom, one last push down. You take out sell side liquidity, and then after price taking out sell side liquidity, right? It's like from sell side and then to buy side, right? And waste buy side resting. Well, it is high, and then that high as well. And then just this repeats on and on and on. Now, like I said, from my personal experience or what I feel like something that is seen to consistently be true is that this is applicable only in a range bound type of market. And a trending market, that will take us to the third principle, right? The third way how the market moves, which is that price will move from internal range liquidity to external range liquidity, and from external range liquidity to internal range liquidity. Okay, so the way the third principle works, this final word, is that, say, in trading markets, okay, when price, you see, say in an uptrend, right, you see expansions going higher, retracement going lower, expansions going higher, right? Basically what happens is that whenever price retraces down inside that range, it's retracing to internal range liquidity. Previously, they also talked to you that it can be anything from an order block, a fair value gap, a breaker block, a mitigation block, whatever is currently there in that range, and so price is going to expand from there. So what that high that was created is going to be external range liquidity, and so price is constantly moving from internal range liquidity to external, and then to internal, and then external, right? All the while trading within a bigger range, of course. The same can be said for a downtrend where price is expanding lower, retrace into internal range liquidity, expanding to external, retrace into internal. So internal range liquidity can be anything from order block, breaker blocks, mitigation blocks, balanced price ranges, fair value gaps, all those kinds of things, right? Now we're going to look at the same charts that we've just been dealing with, the second principle, and we're going to marry them. We're going to just try to merge all the three and just find out how we use them, all of them, to just have a more refined understanding of what price would likely to do next, or where price is likely to go to move to next, if we combine all those three things. Because that's what I do as a process. I just know what to look for and what not to look for, or what to avoid, or when to avoid certain things, right? From this low to the high, that is a range. Okay, so range theory, right? Remember, range theory has to do with premium and discount, and then there's the factor of where we have internal range liquidity and external range liquidity, which is the third principle. So basically what happens is, or what I'm trying to get you to see is, we have premium and discount, and we also have the factor of internal range liquidity and external range liquidity, sort of always going hand in hand. What do I mean by that? I mean that and also by and sales, all these three actually go hand in hand. That's why I'm saying we're marrying them. Okay, so the high here will be your external range liquidity, okay, and the low will be your external range liquidity. Then anything in between will be your internal range liquidity. You would measure the range. Price would move from premium to discount. Now maybe say, since we're gonna look for reasons to buy, or if we know that price is likely to want to buy in discount, right, or that is not going to break this low here, then this area of price from equilibrium, right, to that external range, that low there, is where we're going to look for buying opportunities. So that means premium and discount, that's a check, right? That the second thing is the price moving from internal to external, right? So that means we're going to be looking for internal range liquidity in discount, right? So what do we have there? We have a fair value gap, a discount fair value gap, and order block right there. I'm going to use the body of the candle. You always theorize that one price is going to move, in this particular case, from discount to premium. But the other one, you're going to theorize that price is going to move from internal range liquidity to external range liquidity. So basically, you're gonna theorize that price is gonna move from internal range liquidity to external range liquidity. That is also external range liquidity. Basically, we talk about the buy side liquidity, right? The buy side here and sell side here. Here in this particular case, two things, or we have two of those principles giving us an idea, right, of how price is gonna, where exactly price is gonna head to, and for what reason. Okay, notice that prior, before taking out this high here, this particular high is the one that I really focus on as the extended range liquidity, right? Now you see an expansion higher. Price then doesn't actually take out the high, but it retraces down before it reaches that high. This is a retracement, right? Remember, price is gonna retrace to internal range liquidity and expand to external range liquidity. And if you remember, rebalance the fair value gap. If price rebalances the fair value gap, the next thing price will always expand towards liquidity. All those things, they work hand in hand. Now you can do the rest of price action and just review and backtest it. Learn to frame your thinking in this direction. Okay, learn to view price with these things in mind. Right, learn to read price using just the three simple steps here, three simple principles here. You're gonna be really proficient when it comes to buys. It's a very I think underrated skill and one of the most key things for a successful trader. Proficiency with buys, right? A lot of traders are actually struggling with buys, regardless of how much time they spend, drawing all kinds of things on the charts. But an actual proficiency, missing ingredient. I hope this was insightful. Until the next one.